that it would have to be a voluntary catalyst, because I don't think there's a crypto winner. I mean, at least my personal opinion, I think, ETH is not, a top because it's still the earliest days. And I would say that if there was going to be consolidation, I would think it'd be more natural in the Bitcoin treasury space, because Bitcoin, has made a big move, and I'm still bullish. Like, I think it can go to 1 million, but Ethereum is just so in such an earlier state of where the token value is.
From Bitcoin's role as digital gold to Ethereum's rise as Wall Street's financial backbone, the crypto landscape is entering a pivotal moment that could redefine global markets forever. Ethereum, once seen as a bold experiment, has now matured into the hidden infrastructure powering Wall Street's next financial era. Tom Lee, co-founder of Fundstrat Global Advisors, argues that while Bitcoin has already secured its place as a store of value, Ethereum is entering a pivotal moment in 2025, one he compares to 1971, when the US dollar was decoupled from gold, sparking a wave of financial innovation. This shift is being accelerated by regulatory clarity in the US, the rise of stablecoins, and Circle's IPO, events Lee calls crypto's ChatGPT moment. With additional policy moves like the Genius Act and the SEC's Project Crypto, institutions are now taking blockchain seriously. Importantly, most tokenization projects, whether digital dollars, tokenized assets, or real-world settlement systems, are being built on Ethereum, reinforcing its role as the backbone of financial rails. A decade after launch, Ethereum has grown into the platform of choice for major players like BlackRock and Robinhood, who are building directly on its ecosystem to power stablecoins, tokenized stocks, and instant global payments. Still underowned and undervalued, Ethereum today mirrors Bitcoin in 2017, early in institutional adoption but positioned for immense upside as Wall Street fully transitions to blockchain rails. This is just the first step in understanding crypto's journey. The real story is only beginning to unfold. Stay tuned and make sure to like, subscribe, and hit the bell icon so you never miss the next big shift in Bitcoin, Ethereum, and the future of finance.
From 2017 up until 2025, our focus on crypto has been the idea that, Bitcoin had a very clear place in someone's portfolio because of its not only proven size and stability, but it really is as a way to store value. And then when we thought about how people should allocate crypto outside of that, there were many projects, whether it was Solana, Sui, or the many things that you guys write about. But beginning this year, we started to take another hard look at Ethereum. And the reason for that is that I think that the regulatory picture is moving in a way this year in the United States in a favorable way that is getting Wall Street to take crypto and blockchain pretty seriously. And of course, the killer app or the ChatGPT moment really was stablecoins and Circle's IPO. But following on that was the Genius Act and then the SEC's Project Crypto. And the reason I think this favors Ethereum is many, but foremost, when we look at the projects that are taking place for Wall Street to tokenize assets, whether it's dollars or other assets, the majority of this is taking place on Ethereum. But maybe more importantly, I think, people have to take a step back and realize that what's happening on Wall Street in 2025 it's maybe more akin to what happened in 1971. And in 1971 was the year the US dollar depegged from gold. So the US went off the gold standard. And while gold was a beneficiary of that, many people bought gold, it was actually the idea that Wall Street began to innovate, because suddenly you had a fiat dollar that you now had to sort of move around and create rails for that was not backed by gold. So the real winner there was Wall Street. Well, in 2025, this kind of innovation, blockchain solves a lot of problems and speeds a lot of things. Wall Street moving onto crypto rails, I think, is like a 1971 moment for Ethereum. So I think it's creating enormous opportunities to move a lot of things onto the blockchain. And Ethereum won't be just the only winner, but it's one of the primary winners. And from an institutional adoption perspective, I've heard a lot of people talk about this. Bitcoin's already become very institutional. When I talk to investors and I do meetings, they understand how to sort of understand how to model or even think about future value for Bitcoin. And it is in a lot of people's portfolios. Ethereum is so underowned that it's more like Bitcoin in 2017. I don't think Ethereum is actually viewed as an institutional asset today. So I think it's so early, and that's why I think there's a bigger opportunity. Yeah, now that's not near term. So I don't want to be held to like someone saying on December 31 it didn't achieve
That wasn't for next week, Tom, because I thought that was one of those next week targets you do.
But yes, and actually, I'm citing work when we did that analysis for ETH. It was some research done by Mosaics and some other folks, and what they wanted to do was, again, approach it as if this is a 1971 moment, and so they wanted to think about the value of Ethereum as both a payment rails, okay, and then capturing a portion of payment volumes. And so I think both are kind of additive concepts. And so their idea is that if you look at the addressable market for what it takes place on the banking system and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, okay, which is about 450 billion a year, and assume there's a gas fee per transaction, and then what it means to essentially network revenue. You apply, I think, a conservative 30 multiple to that, you get roughly 3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000 per unit. And again, that's that's an 18x roughly from here.
In the evolving world of crypto finance, survival isn't just about innovation. It's about balance sheet discipline and strategic foresight. Tom Lee emphasizes that when assessing financial instruments, trade-offs are inevitable. Common equity, he notes, aligns all shareholders with the same long-term upside, fostering unity in a company's growth story. By contrast, convertible debt or preferred instruments introduce conflicting incentives. Investors may prioritize volatility capture, hedging, or fixed returns over broader success. Such misalignment, he warns, can suppress liquidity and work against the natural growth flywheel that drives market performance. In Lee's view, the next crypto winter, an event he sees as certain, will reward firms with clean balance sheets, as they will avoid funding stress, derivative-driven spirals, and destructive dilution. While at-the-market equity offerings may look attractive when trading above net asset value, NAV, Lee argues that the math rarely justifies the risk unless premiums are sizable. Strategic prudence, rather than short-term funding tactics, remains key to long-term resilience. Bitcoin's straightforward balance sheet and MicroStrategy scale exemplify the benefits of structural discipline. This framework echoes the shift during the COVID-19 era, when corporations began adding Bitcoin to their treasuries. While many adhered to traditional finance models, others boldly declared Bitcoin as a strategic reserve asset, signaling how crypto has evolved from speculation to a legitimate pillar of corporate financial strategy. Let's get back to the interview.
I'd probably be curious Sean's take, because I know he's done a lot of comps on this, but I think that here's the weird math. In theory, there's a trade-off with every instrument because, and this might be too technical for your users, but like common equity is a great instrument because it gives everybody the same upside opportunity. And there's no conflict. Like if someone's buying the shares, even a future shareholder, they all are betting on this future success of the company. But when you sell a convertible instrument, okay, now someone is trying not to just care about your stock price, but they care about capturing volatility and even maybe hedging it away. And, as you know, options chains aren't as liquid as they look because when you focus on a single contract, you could crush volatility. And, preferred stocks and debt are basically debt obligations. I mean, in theory, Ethereum treasury, anything that gets staking yield can like afford to pay it, but, it's a debt. So now that a debt holder doesn't care about the shareholder success, they just want to get their interest payments. So when you change your capital structure, you're introducing conflicting initiatives and like different motivations. And actually, they can also hurt your company because if you have too much convertible debt, you're suppressing volatility. And then therefore, that's like works against the flywheel because volatility is the reason you might have a liquid stock. So if someone was to try titrate that and say these are the different levels that it makes sense, I don't think you could actually solve that with a calculation. I think that, and for instance, another thing to keep in mind is in the next crypto winter, which is a guarantee, the first principal cleanest balance sheet company is going to win. So, because then you don't have to go into a funding issue trying to fund your payments with selling equity, and you don't have some derivative structure that is essentially natural short, but then they have to, because of coverage ratios, they short you more as your stock falls. Like you create death spirals. So I think that's why like Bitmine has just stayed pretty clean. And if you're trading above NAV, it's really hard to justify doing an ATM if you're only at 10% premium. Okay. Because the way the math works, if you're at 1.1, you sell equity, only that 10% premium goes to to accrete your shares. You have to sell 100% of your float. You have to double your share count to really have a positive impact on your holdings of ETH per share. Think about how much dilution that is just to try to, but if you're trading at 4 NAV, you could double your ETH held per share by only selling 25%. So I guess when Saylor has his metrics, that's what he's thinking about, but I don't think of it that way. I think it's probably better to be more strategic and realize like that. I mean, one advantage again of like Saylor is he's a $100 billion market cap. And so he has a lot of different products available. By the way, the next largest crypto treasury after that is Bitmine in the world.
In conclusion, Ethereum's trajectory signals more than a market trend. It represents the foundation of Wall Street's next financial era. Much like Bitcoin in 2017, Ethereum remains undervalued and underowned, yet it is rapidly becoming the core infrastructure for tokenization and blockchain rails. Tom Lee reminds investors that balance sheet discipline, not just innovation, will determine the real winners in the next crypto winter. Just as Bitcoin evolved into a corporate reserve asset during the COVID-19 era, Ethereum now has the chance to anchor institutional finance. The key question: who will capitalize as blockchain reshapes global markets? With Ethereum emerging as Wall Street's new financial backbone and Bitcoin proving the value of balance sheet discipline, which crypto asset do you believe is better positioned to lead the next wave of institutional adoption? Crypto is shifting from speculation to the backbone of global finance. Stay ahead. Like, share, and subscribe for insights on Bitcoin, Ethereum, and markets. Until next time, stay sharp and invested.